Welcome to the Explainer. So look around you for a second. The physical world is just filled with tangible wealth, right? The house you live in, the art on your walls, maybe even a bar of gold sitting in a vault somewhere if you're lucky. Now, for centuries, trading these kinds of assets meant dealing with mountains of paperwork, armies of middlemen, and serious geographical barriers. But what if you could take literally any physical asset on Earth, divide it up into digital fractions, and trade it globally in under a second? Well, this isn't science fiction anymore. Back in April 2026, the International Monetary Fund actually declared that this technology, tokenization, is fundamentally rewiring the entire architecture of global finance.
Tobias Adrian, who is the financial counselor over at the IMF, hit the nail on the head with this quote. He's arguing that tokenization isn't just some minor tech upgrade or a slight efficiency boost for existing infrastructure. We are looking at a complete, ground-up structural overhaul of how financial markets operate. The very concepts of trust, settlement, and risk management are being totally reconfigured.
To really wrap our heads around this shift, we first need to define what real-world assets, or RWAs, actually are. Basically, RWAs are tokens that represent existing forms of wealth. By taking a representation of real estate, gold, or fine art and moving it onto a blockchain, we're translating it into a digital form. And that's a game changer, because it allows the asset to be divided up among multiple owners, which totally democratizes investment and makes it incredibly easy to trade on a global scale. Now, these assets generally fall into two main buckets. On one side, you have tangible RWAs. These are things you can physically touch, like those massive 400-ounce gold bars or commercial office buildings. On the flip side, we have intangible RWAs. These are non-physical assets that still hold massive value, like government debt, intellectual property, or equity in a company. And the wild part? Both kinds can be transformed into units of value on a digital ledger.
Section 1. How tokenization actually works.
Let's look at how this plays out in the real world with a company like Paxos. They're taking actual, physical 400-ounce gold bars and translating them into digital tokens on the Ethereum blockchain. Each token is backed by exactly 1 ounce of real gold. And we are just talking about numbers on a screen here. If you hold those tokens, you can actually redeem them for physical gold at any point.
But it goes way beyond traditional commodities. Take a look at Courtyard. They tokenize physical, graded trading cards. You just ship your valuable baseball or Pokemon card to their secure storage facility in the US, and they mint it as a digital token. Boom! You can now trade that card instantly, anywhere in the world, completely bypassing the middlemen and all their fees. Plus, whoever originated the token gets a 1% royalty every single time it changes hands. And yeah, you can swap that digital token back for the physical card whenever you want.
Now, for the big institutions, bridging that gap between the physical and digital worlds requires 4 highly regulated steps. First, the underlying asset continues to sit securely over in the traditional financial system. Second, a legal structure, like a special purpose vehicle or a trust, is set up to link that asset directly to the digital token. Third, the token gets minted on the blockchain. And finally, smart contracts take over. They automatically handle all the heavy lifting, like know your customer checks, transfer restrictions, and overall compliance, right there within the token's code.
Section 2. The institutional market boom. Once you get the mechanics, it's pretty clear why traditional finance is shifting so fast. I mean, BlackRock CEO Larry Fink has straight up called tokenization the next generation for markets. And they are definitely putting their money where their mouth is. They've partnered with companies like Securitized to launch RWA funds, and they have this huge stated vision to eventually tokenize up to $10 trillion of their assets. To put that momentum into perspective, just look at this number. As of April 6, 2026, the distributed asset value was sitting at $27.65 billion. That represents the tokenized assets, not counting stablecoins, that are actively trading and settling directly on distributed ledger infrastructure. But the number that really makes you stop and think is $441.38 billion. That is the represented asset value. And it's a massive deal. It reflects the sheer amount of capital that major institutions, banks, and asset managers have already committed to bringing their underlying assets into tokenized structures, even if they aren't fully trading on-chain just yet. So who exactly is in on this? Well, the data shows we've got over 710,000 asset holders right now. But don't be fooled, this boom is overwhelmingly driven by institutional capital, not your everyday retail investor. That's mostly because of the high minimum investment thresholds.
Currently, tokenized U.S. Treasury products are leading the pack in on-chain value, while private credit tokenization is seeing the fastest growth by percentage.
Section 3. The global regulatory landscape.
When you have hundreds of billions of dollars at stake, governments tend to move pretty quickly. The first quarter of 2026 was essentially a historic sprint for U.S. regulation. In January, the Clarity Act cleared the Senate Agriculture Committee. Then, on March 5th, top banking regulators came out and explicitly said that capital rules are technology neutral. That means a tokenized security gets treated exactly the same as a traditional one. And less than 2 weeks later, the SEC and CFTC dropped a joint interpretation officially naming 16 crypto assets as digital commodities. All of those regulatory shifts sparked what we're calling the OCC charter wave. Heavy hitters like Circle, Ripple, and Paxos are securing national trust bank charters, and this is exactly the prerequisite institutional capital needs to enter the space at scale. It sets up a federally regulated custody infrastructure, giving these companies the national operating authority to legally hold digital assets as qualified fiduciaries.
Meanwhile, over in Europe, they are taking a highly structured approach with two main frameworks. First, there's the MiCA regulation, which licenses crypto asset service providers. But for tokenized traditional financial instruments, they've set up the EU DLT pilot regime. This is basically a regulatory sandbox that's been active since 2023, and it allows major players, like the European Investment Bank, to safely test issuing and trading digital bonds right on the blockchain.
Section 4. The IMF's systemic warding. Now, despite all this massive adoption and regulatory clarity, the International Monetary Fund is actually sounding the alarm. They aren't just giving this a rubber stamp. They've pinpointed 4 highly specific systemic risks. First, there's fragmentation, where liquidity gets split up across disconnected digital platforms. Second, they're worried about the amplification of financial instability. Third, we have unresolved cross-border jurisdictional rules, meaning if a global transaction fails, whose laws actually apply? And fourth, there's a serious risk of rapid capital flight in emerging markets that don't have the proper regulatory infrastructure yet.
To really grasp their biggest fear around financial instability, we have to talk about a concept called atomic settlement. In traditional finance, transactions can take days to settle, which gives the market this built-in end-of-day buffer. But with atomic settlement on a blockchain, payment and delivery happen simultaneously, instantly.
And here is where the core debate lies. The IMF looks at continuous instant settlement and sees a massive risk. They argue it compresses the time humans have to step in during a market panic, which means automated shocks could spread much faster without those traditional safety buffers. But critics, like Jesse Knutson from Bitfinex Securities, argue the exact opposite. He says that speed is a feature, not a bug. It cuts out the intermediaries and gives investors direct control and flexibility over their own assets. For him, stability shouldn't be engineered by forcing artificial delays.
Section 5. The future of finance.
So, as traditional finance and blockchain tech hurtle toward this massive convergence, what exactly comes next? Well, the IMF has laid out a policy prescription to try and secure this future. They want settlements anchored in safe money, like central bank digital currencies. They're pushing hard for consistent cross-border regulations and standard interoperability between all these platforms. But most importantly, they need legal certainty. Places like Singapore, the UAE, and Switzerland, especially with their 2021 Blockchain Act, are already pioneering laws to make sure smart contracts hold up in a physical court of law.
The urgency here is absolutely real. As the IMF warned, the window for regulators to actually shape tokenized finance is still open right now. But this tech is moving at breakneck speed, and that window is going to close eventually.
Which leaves us with this final overarching question to really chew on. We are watching the birth of a vastly more efficient, barrier-free global market. But will the democratized efficiency of tokenized assets ultimately outpace the systemic risks they introduce to global finance? Make no mistake, the choices institutions and regulators are making right now are deciding the financial architecture of the future.